Welcome to the Better Podcast, where you and I get better in this game called life. I'm Chin, your co-host today, and I co-founded The Smart Investor, an investment site where we talk about stocks all day.
And I'm your co-host Ser Jing. I run the Good Investors investment blog and a global equities investment fund together with my friend Jeremy Chia. Now, before we start, here's a disclaimer. Nothing on this show should be taken as investment advice. It is purely for informational and entertainment purposes only. All opinions expressed in this show by us and our guests are solely our own opinions. We and our guests may hold positions in the financial assets discussed in the show, and these holdings are subject to change at any time.
Hello everyone, it's the 23rd of June and we're back together with myself and Ser Jing. As usual, we don't know what we're going to talk about today, but I'm going to hand the ball over to Ser Jing today. What are we talking about today, Ser Jing?
Yep, so the first thing I would like to be talking about today is information that I've gotten out from a book called The Bond King. And it's written by Mary Childs, and it's actually on Bill Gross, who is the co-founder of PIMCO, one of the largest investment management firms in the world and a really huge player in the bond market. So in the book, I realized that Hank Paulson became Treasury Secretary in 2006. So the Treasury Secretary is essentially kind of the equivalent of the Minister of Finance in Singapore, right? So a really important role within the country. So he became the Treasury Secretary in 2006. And before he joined the government, Paulson was the CEO and chairman of Goldman Sachs, so one of the largest investment banks in the US. Now, Paulson had an aide by the name of Neel Kashkari, and he was also a banker at Goldman. And interestingly enough, Kashkari actually got the job after cold calling Paulson. So when Kashkari realized that Paulson had become Treasury Secretary, Kashkari picked up the phone and gave Paulson a phone call saying that, hey, I would love to join the government and help you out. And lo and behold, Kashkari became Paulson's aide. Now, when Kashkari became Paulson's aide, he created a 10-page plan called Break the Glass Bank Recapitalization Plan. Now, it was actually a kind of a blueprint for which the government could use in the event that there was a collapse in the global economy and when financial institutions needed to be rescued. Now, interestingly enough,
this was
2006.
Okay.
Yeah, so I was going to say, interestingly enough, like just a year or so later, when the great financial crisis erupted, Kashkari had to take that 10-page plan that he wrote to use as the blueprint to create a lot of the programs that the Treasury created to help save the financial system. Now, one of these is actually called TARP, or TARP, which stands for Troubled Asset Relief Program. Now, the TARP can actually be used. Yeah. It's one of the alphabet soups that the US government came up with to rescue the financial system. So what the TARP can be used for is to buy toxic assets from banks or preferred shares. And essentially, it can be used to buy anything in order to save the banks and to save the financial system in the US. Now, what was interesting is that as Kashkari and Paulson came together to work out what the TARP would look like, they had actually no idea how much money was enough, right? And so eventually, I think the number they came up with was $700 billion US. It was essentially a number that they pulled out from the air, from the sky, right? It was like them doing this. Okay, $700 billion it is. And how it came about was Kashkari actually wanted $1 trillion.
Just for the knowledge of people, Ser Jing just put his finger in the air for people listening in. Yep.
Yep. So Kashkari actually wanted $1 trillion, but Paulson was like, I don't think Congress would agree, so let's go with something a little bit lower, but yet large enough. And so I think they eventually came up with $700 billion. Now, when I came across that passage from the book, I was reminded of another podcast, and this time it's called I Am Home, and it's a podcast created by Nebraska Furniture Mart, which is a Berkshire Hathaway company. Now, I'm reminded of that podcast because I was actually somewhat surprised that Kashkari and Paulson did not know how much was enough to actually save the financial system in the US. And for those who don't know, TARP was actually a really important program because it really helped to act as one of the very first stabilizers in the US financial system when the great financial crisis erupted. And it was surprising to me that even people with the experience of like Kashkari and Paulson did not know how much was enough, right? And they essentially put the number out of thin air, right? And so back to the Nebraska Furniture Mart podcast. So Nebraska Furniture Mart is, of course, a Berkshire Hathaway company, and they recently interviewed Ted Weschler, who is one of Warren Buffett's lieutenants in charge of making investments in both the public and private markets. So during the interview, Weschler shared that during COVID, in March or February 2020, he said that it was a really tough time from an investing standpoint because him and Buffett and Todd Combs. So Combs is the other investing lieutenant that Buffett had hired a few years ago. So the three of them would meet and they would, they would realize that they had not seen anything like that before during COVID. And they had a lot of good information coming to them simply because Berkshire Hathaway is such a sprawling conglomerate, like with fingers in many different parts of the US economy. But they had no relative edge. And those were actually Weschler's words, right? Like they had no relative edge. And I thought like the Nebraska Furniture Mart podcast and the information I got from the Bond King about Kashkari and Paulson, I think it points to this really important idea of having humility when operating in the financial markets. Because, again, Paulson and Kashkari were bankers in Goldman Sachs, and Paulson was a really important executive at Goldman Sachs, and that is one of the largest investment banks in the world. So Paulson knows a thing or two about finance and about the economy, right? But even then, like I said, he had no idea how much was enough to actually save the economy of the US during the financial crisis period. And like when it came to COVID, people with the experience of like Buffett and Weschler and Combs, they also had no idea what to expect or what to do when the crisis came. And I think this is just such an important reminder of humility. Like when, as an investor operating in the stock market, I think we are often faced with information or new events and situations that we have never encountered before. And I think that when we are faced with such things, I think it's really important to admit what we don't know, right? And think about what are some of the important cornerstone attributes of the financial markets or the stock market that will likely not change with time. And having this kind of everlasting traits will be something important in which we can base our investing actions upon. Yep. So with that, I would like to hear your thoughts.
Right. So I think the great financial crisis, I went through that myself. That was probably my third year of investing in stocks, or maybe my, where was it? 1, 2, 3, third year, right?
I started to date yourself.
Yeah. Yeah, I sound really old now. So I started investing. I think I bought my first stock somewhere in 2005. So 2007 was it was a period of 2 years for this crash. It sort of unfolded, and then at a certain point became really serious because it became clear that there's this very strong chain reaction, spreading across the entire financial system. And if banks don't trust each other, that's a huge problem. Just think about if your company bank is say DBS and you have to pay your employee who has a UOB account, and if these two banks don't trust each other, then the company can't pay your salary, right? So it was an unusual time, and in a sense, I think that it was a very harrowing time where some banks said that they did not need the cash, but were given it anyway. There was, I remember GM and Daimler had to go through what is now called a surgical bankruptcy. So shareholders of the old shares actually went to zero, and then there was this new shares issued. Ford, on the other hand, was the only one which actually had the luck to actually compile and stockpile a huge amount of cash. And I remember back at the time, it was a very controversial decision because they actually, literally, I think they mortgaged the entire house, right? They even mortgaged,
I think,
the blue
logo, right?
Yeah. and it was such a timely decision by Bill Ford, which set the stage for Alan Mulally, who came in later to actually revive the company, streamline everything, and make Ford a better company overall. So I think that one case which I remember was AIG. And this probably gives you a sense of what happens during financial crisis. So there was one division in AIG which took on too much risk. which then sort of impacted the entire company itself. And the interesting thing I think about AIG was they had the assets to actually pay for all these liabilities. The only problem is when you're in a depression, or not a depression, a great recession, nobody wants to buy your assets, right? And even if they do, it's going to be priced down extremely low, right? I remember back home in Singapore, you have Capital Land Mall Trust. You're trading at 0.6 times book value, right? So that it was that dire, like very strong, very highly visited malls were marked down by 40%. You could get Parkway Life REIT giving you 10% yields, right? This is a very stable REIT backed by hospitals, right? And REITs actually got into trouble because they couldn't refinance their loans. But back to AIG, basically what they needed was just that sort of bridge loan, which allowed them the time to actually unwind the entire company. And that was actually what happened. Robert Steve Miller, who was the CEO of Delphi, he is actually famous for managing bankruptcies. I actually highly recommend, if you have time, I'm going off in a tangent here, sorry about that.
I love it.
Do pick up his book on the Turnaround Kit by Robert Steve Miller. He's an excellent writer. He doesn't need a ghostwriter, one of few CEOs who writes in such candid manner. So it goes into really deep into details of how you actually go through a bankruptcy itself. And for a person going to has actually managed through, I think, at least 10 plus bankruptcies, if you want to learn anything along about bankruptcy itself, Robert Steve Miller is the right person. And basically, so back to AIG, basically, again, you have this company which took on too much risk, or one of the division which took on risk. They have the assets to actually pay for their obligations, but then they had to actually find the time, or be given the time, to actually unwind and do all this asset sales. And from it, you can see they spun out AIA, for example, and they listed in Hong Kong, and AIA has actually thrived since then. So actually those assets inside were actually pretty good, right? AIA was one of the crown jewels, it seems. So I can understand to a certain extent why it was so hard to come out with the number, because just think of the case of AIG, right? Like, I need time to unwind my assets. How long? Like, I don't know.
No one knows.
Right? And that, how long would dictate how much cash burn you have to go through, right? And will the people who are waiting on your loans, because it's not whoever AIG doesn't pay, there's a cascading effect, right? The companies connected to AIG will then also collapse and might pull everyone down with them, right? So there was this saying from Buffett at that point of time, where it's not just who you're in bed with, but who they have been in bed with, right? There was this chain reaction, and if one part of the chain collapses substantially, it could bring down quite a number of players. So it was a harrowing time. So to a certain extent, it's good to know that even if you're an expert, you do not know what's happening, and you may suffer like short-term losses. And I think maybe it's to tie it back to today, to make it interesting, right? I think that sometimes
it's always interesting.
I think sometimes people, I'm beginning to get the sense that as you look back 1 year ago in November, right, when the stock market peaked, and now we had this very sharp downturn for the past now it's June, so now it's around 7 months now, right? And I think that it's very natural to have that feeling that, oh shoot, I wish I sold in November. I should have been more active. It was so obvious. And that to me is really about hindsight bias, right? You look back,
Yep.
you think, oh, I wish this was that. And I think that, there's this, and I think the idea starts forming in some people's head that to be a good investor, you have to know when to exit. And I'm not sure I agree with that, right? Because if you look at Buffett himself, Berkshire Hathaway, right? Since 2090, right? So roughly about 30 years. The share price has dropped for Berkshire Hathaway by more than 45% twice, right? So even Buffett, being one of the best investors of our generation, is unable to time the market perfectly and has suffered major declines. Currently, I think Berkshire Hathaway is down 25%, I think. And that's even more than the S&P 500. And that, to me, does not signify that he's a lousy investor. It just tells you that this is part of the process. But I'll let you chime in if you have any thoughts on that.
No, I wanted to just add on about the part about the hindsight bias, like the idea that, oh, I knew it all along. I think that's really dangerous because and it somewhat plays into the topic of humility, simply because, if you think that you know it all along, and when the next crisis or the next crash happens, you might end up acting in a way that would harm your portfolio. I think one of the worst things that can happen to an investor is for him or her to think that he or she knows more than he or she actually does, right? And I think that's one of the biggest ways that someone can get into trouble in the stock market.
No, and I think that we should also recognize that 2020, 2021, and already 2022, right? I think this is a period where things are so abnormal, right? I know
Indeed.
that we have gotten used to this abnormality because we have lived through it for 2.5 years. But when you think about it carefully, none of this is normal, right? None of the kind of demand swings which you're seeing in 2020, where the streets of Singapore just emptied, everything just shut down for 2 months during the circuit breaker, and then now you have this resurgence of flights and people pouring out, and there's revenge spending. So all this like huge swings in demand, none of it is normal, and I'm a bit I'm a bit afraid that our younger investors out there may sort of go through this period and form long-term lessons out of a very abnormal period. And I think that's really dangerous. I think the best lessons are actually learned if you take a longer-term view and see how things play out over the long term, because there are lessons to be learned from this period, but don't learn the wrong lessons.
I completely agree. I think sometimes people learn lessons that are too specific. I think a really good example will be there was an article that I think Morgan Housel once wrote that said that one of the lessons that people learned from the dot-com bubble is to not speculate with internet stocks, and they end up speculating with biotech or like auto stocks or whatever you have, right? And that is the wrong lesson to have. The proper lesson to have is actually to pay attention to valuations and to pay attention to companies, to which companies actually have viable business models. So that should be the correct lesson. But I think sometimes people may end up learning lessons that are too specific, and these turn out to be wrong. Yep. With that, let's move on to the next topic. So the ball's in our court now, Jin.
Yeah. So I was reading this report from Benjamin Venture Partners. So this is a fund which actually invests in seed and Series A. So you can consider that pretty early stage investing. So the companies they've invested in so far are like I just took a peek. So Twilio, Shopify, Twitch, LinkedIn, which is now under Microsoft, and Pinterest. So quite a very interesting mix of companies. What is interesting also is they have something called an anti-portfolio, which they basically said that these are the companies we missed, right? We could have invested in, but we missed. And I thought this was a really great practice, because they listed companies like Airbnb, Atlassian, Apple, and even Google and Okta and PayPal, right? Tesla too. So some big misses there, but overall, I think they're still fine, right?
They probably have done really well.
Yeah, like Peter Lynch once said, "You can't kiss all the frogs," right? So, one of the most interesting things which they do is they have what you call a state of the cloud report, which they come out every year. And last year had, I think, 7 predictions, and I wanted to look at this year's report and sort of share three of the predictions they have and sort of get your thoughts on that, right? So the one of the first predictions they have is and let me scroll here really quick. They're talking about the sort of the power of the cloud and the difference between the first act and the second act, right? Sometimes there's the statement is you come for the function but stay for the community, right? So one of the biggest examples they pulled out was Shopify, which used to be just a software for you to build your storefront, but from there the second act came where they actually added payments, and this became their second act. And today, merchant services, which is a division under Shopify itself, is actually growing and driving most of the growth at Shopify. So that's sort of the second act, which Shopify is able to come up with. And the point here is that they're saying that there's all these SaaS companies which are providing APIs behind all these front-facing or customer-facing companies, and these are companies like Stripe, for example. So Stripe is a payment service where you're able to just, as a developer, enter a few lines of code and have a fully working payment system for your site itself. And Stripe actually powers Shopify payments, right? So this is one of the sort of trends which they see. So I'm going to pause here for any of your thoughts.
So I think the idea of having these API companies is really powerful. I think I might even have spoken about this in one of the earlier episodes of our podcast in this concept called the API first company, right? So I think it is a interesting lens that I use as well when I think about companies. I think about which are the companies that are providing all the infrastructure for other companies to build upon. And when a company is able to successfully, provide the infrastructure, they become a picks and shovels play, right? And it doesn't matter. And then when that happens, it doesn't really matter who's the winner or who's the loser or what industries are going to win or lose. They're just going to be there to rake in the money, right? So I think really great examples today. There will be AWS of Amazon, and of course the big three cloud providers, not just Amazon, right? AWS with Amazon. There's Azure with Microsoft, and GCP and Google Cloud with Google. So and they are the ones that are providing the cloud computing infrastructure on which many other companies can build their own special products and services. And it's interesting that you mentioned this, because just earlier today I was listening to a podcast, and in it during the podcast the presenter, it's a podcast by the Acquired family. So it's I think the hosts are Benjamin Gilbert and David Rosenthal. So they shared this really interesting story about Jeff Bezos. So I think in 2008 or 7 or something like that, Bezos was giving a talk at a Y Combinator event, and at that event Airbnb was there. Just one interesting side note. and during the event, that was kind of like near the genesis of AWS, and Bezos was there trying to pitch AWS to this whole bunch of startups that were at the Y Combinator event. And Bezos shared this interesting story about beer brewers in the early 20th century. So I think that would be like the 1900s. And he said that at that point in time, electricity had just came about, and if beer brewers were able to make use of electricity to produce beer, would be able to produce much higher quantities as they did before. But what was interesting was that some of these brewers in the earlier days were actually building their own electricity generators. So they were not making use of the electrical infrastructure that society had built around them. They were actually trying to build their own. But Bezos went on to say that doing so did nothing for their consumers, because what the consumers really cared about was the quality of the beer. They did not care how good or how poor your electricity generator is, right? Like, it doesn't do anything for the beer. And so he came out with the analogy that you should always focus on making better beer, right? So his idea was that if you are a like in the case of Airbnb, if you're in the business of providing really interesting travel destinations and travel accommodations for people, that's what you should focus on. You shouldn't be focusing on thinking about how should I build my database, how should I host my data, how should I build my data pipes and so on. Let AWS do all of that, right? And I mean, look at what AWS has become today, right? It's just a behemoth of a business.
Now I'm going to go off in that tangent because I have a funny.
Please do.
I once went to this was in, I think, Zhejiang in China, right? and there was this Indian supplier which does fasteners. Company name is Sundram Fasteners. And if you've been to India before, and I'm speaking now about like 20 years ago, right? So I'm sure India has made a lot of progress since then. But 20 years ago, it was actually very common for Indian companies to have their own electrical generators. And the reason is because the sort of natural grid was not very reliable. So you have, if you're going to have a factory, you have to have reliable utilities, right? So it was very common practice for them to actually have their own energy plant and implement all this green technology or green energy practices. So when they set up a plant in China, one of the interesting things is that they actually got the road to be renamed to the One Sundram Road in China, right? which I thought was amusing to no end. And then
That does tickle me.
yeah, and then they did what they did in India, right? They set up their own energy supply and so on. And it so happens that at that point of time for that city of China, they were big into green energy, right? So there was this very nice sort of congruence in objectives, right? The Indian company going to China and they actually set up, create more jobs, and they actually brought in green energy as well, which fits the town's objective. So I just thought that was a nice little story to sidetrack a little bit.
No, I really like that story. I mean, One Sundram Road in China. That's quite amazing.
Yeah. So let me point out another trend as we go on. The second trend, which I think that they brought up by Benzimer Partners, is that the go-to-market motion, right? So there are different ways a company which does SaaS actually markets its products, and they're arguing that cloud marketplaces are going to become more and more important as a sales channel. And in this sense, I think that if you think about Salesforce as their own marketplace where they sell third-party apps. I think Zoom is trying to start up one. Microsoft Teams has also started off one. I think they have over 1,000 integrations now. And then you have Atlassian, which is also having this very vibrant marketplace. Shopify also
has one too. Yep.
And I think the objective of the marketplace also is to it's for if you have sort of like a horizontal solution, which is call it a cookie cutter solution for everyone, it's not gonna fit very nicely for all these vertical industries which have very specific requirements per industry, right? So, for example, in the healthcare industry, I've done what you call GMP audits before, where there are very specific sort of requirements when it comes to your own documentation. A very simple one to understand is, for example, whenever you write something down, you cannot delete it, right? Whenever you delete something, you have to actually sign for it. So you can't use liquid paper and just delete it and write over it. Whoever does a deletion, you have to strike through it and then sign off, date it, right? So that's one of the requirements for the healthcare industry itself. And also these tiny requirements needs to be implemented within whatever you do, right? Within the healthcare industry itself. Another one is Viva Systems. When you do a marketing email to a doctor, right? So if you're providing software for your client to send emails to your doctor, they can't just make any claims which they want, right? Whatever claims they make, whether it's a percentage of, like COVID vaccines, right? What's the efficiency rate? Efficacy rate, sorry. I'm stumbling over my words. So you can't just plug any number you like or read some number off the internet and just quote that number, right? You need to back it up with documents, with studies, and you have to refer to your studies when you make that point like this. So there needs to be all these linkages in the emails, and these updates or all these studies have to be updated. So whenever you send that email, you're quoting the most updated information. And these are the sort of requirements which Viva does to customize something as simple as CRM tools for their customers itself. I wonder if you have any thoughts on that.
Yes, so with regards to marketplaces, I think it's an interesting idea that Desimir has brought up in that marketplaces would become more and more important as a go-to market channel. I can see some of the logic in that. I mean, um, you have some of these companies like say Shopify that attracts a lot of users in the form of like small time or smaller merchants as well as the larger ones, and these merchants often would require other services that Shopify would not be able to build, right? And if that's the case, then it totally makes sense for third-party developers to, or rather, it totally makes sense for Shopify to open up its platform for third-party developers to help fulfill some of the needs that Shopify itself cannot for its merchants. Yeah, so I think it's an interesting development. I do wonder if there would be differences in terms of like the skill sets that software sales teams will need when it comes to trying to push sales through the marketplaces of many of these different platforms, because I would imagine that say a Salesforce marketplace could look quite different from a Shopify marketplace. That's just me speculating from the perspective of an outsider. I'm not a software developer, nor have I worked with one before, so I'm not sure how it looks like. But yeah, just wondering if there will be any big differences in terms of the skill sets required there. But yeah, definitely can see the logic in what Basimir has said.
I think you're right in the sense that there's probably still going to be like multiple sales channels. I'm not so sure about this trend though. I mean, like it may be also dangerous if you're too dependent on the marketplace, right? Then, like Facebook and being on Apple's platform, you are then subject to Apple's rules and regulations. We have seen what can actually.
Yeah, that's a really good point. Well, I guess you have to have a certain amount of trust in whoever it is that's running the platform. So, like, I guess if you look at Shopify, it has publicly stated and has officially done so in terms of removing some of the revenue share for third-party app developers. So, I guess from that perspective, it may make it more comfortable for third-party software developers to build on the Shopify app store. But you're absolutely right. I think that if you depend too heavily on third parties, if you depend too heavily on a platform's marketplace as a sales channel for your own software, that could create some potential risk in the future.
Yep. And I think maybe one of the channels which is usually maybe not so, it's not brought up that often, is the ISVs or the independent software vendors, right? So these are people who have the connections to actually sort of walk through the customers into the implementation process. So, I think it's a very natural progression for a company to market online, so they can sell it online through a freemium model. They have marketplaces which they can sell to, and also have ISPs. So there's sort of this diversity of channels. So I think that this might be a good place to end. But I'll leave it to you, Ser Jing, if you have any last words.
No, I don't. I think that is a really good place to end. So, yep. See you all. Thank you all for your time listening to us ramble on.
Yeah. So thank you, everyone, and we promise not to talk about DCF. Shout out to. See you guys. Bye.